We're here at Super Return in Boston. I'm joined by Bruce Evan, who is the chairman of Summit Partners. His firm manages growth, venture, credit, $11 billion under management. Bruce, can you tell us how you're spending your time in terms of evaluating investment opportunities these days?
Sure, well Summit Partners, as you said, does late stage venture, growth equity, and credit investing. The core of our business is growth equity. We spend probably 2/3, 3/4 of our time on the technology sector. We're also active as healthcare investors, healthcare services in particular, and then other things that grow, which for the most part recently has been things around the financial technology, business services, and energy sectors.
I know that your focus is tech, so can you talk a little bit about, specifically you mentioned financial technology, but what are the macro forces at play that are potentially influencing the way that you pick investments?
Well, I mean, there's lots of great macro forces in play on the tech sector. I mean, big data is one of the things that people talk about. The movement of video from fixed networks to mobile networks is another one. Security, as we move to the cloud, you've got to protect your data, and there's got to be ever more sophisticated ways to do that. And then lots of the internet strategies that developed 10 years ago without business models have great business models now. They don't take much cash, and there's lots of growth opportunities associated with that.
Now, one of the things that you do is that you're involved in the National Venture Association. Is that right?
That's right, National Venture Capital Association.
And so, obviously you guys are big growth players for a long time.
That's right.
Why did the National Venture Association reach out to Summit Partners?
Well, because the National Venture Capital Association thinks that venture capitalists create and grow companies, and what growth equity players do is they do the grow part. And so there's a natural link between the earlier stage venture firms and the growth equity firms around the idea of providing financing to emerging growth companies. And we're bound together by that. We act in a manner as a private alternative to the public markets.
Is that because companies are staying private perhaps longer?
That's
younger
right.
companies are staying.
Companies are staying private longer, and a couple things happen. The companies continue to need financing, number one, and number two, the earlier stage investors need liquidity so they can show results, so they can raise their next fund. And we sit there and we provide financing to the companies to help them grow on the one hand, and we provide liquidity to those earlier stage investors. And
talk to me about returns over time, venture versus growth equity returns. How have the two compared historically?
Well, I think that it's an interesting thing. Cambridge Associates is working on benchmarking the growth equity sector right now, and I probably the easiest way to describe it is our returns track between the venture returns and those of traditional private equity. We're less sensitive to the debt markets. We're much more sensitive to the IPO markets, but we're less volatile in between those two drivers of returns to the industry.
Now, you mentioned the IPO markets. Obviously, the window has been open for some time now.
Yeah.
When do you think that window may close? And more importantly, what has the investor psychology been around IPOs since Facebook?
Well, Facebook's sort of less important than the overall health of the market, and I would say, generally speaking, that people have been excited that the IPO market is coming back, are trying to take advantage of it as much as they can. There was lots of tax-induced selling towards the end of 2012, and my sense is we're going to have a return of that phenomena this year because investors just don't know when tax laws are going to change. Corporate owners, entrepreneurs, the same. There continues to be good need for capital because the economy appears to be on the upswing.
But either way, you guys can capitalize on a market that is not perhaps as frothy as we've seen, right?
Yeah, to me it feels like a good, healthy market. There's lots of people that say it's going to keep going, and there's lots of people that say it's not.
Well, what's
it's
your
probably
take?
What it needs to be. I think it's going to keep going.
Okay, and in terms of valuations, I mean, we talked about overall issuance, but valuations in those IPOs have been pretty high.
Yeah, well, I think that's one of those things that's a matter of opinion. I think that if you take a look right now, they look healthy. By some measures, they look historically high. By other measures, at the front end of an upturn, maybe they're not.
Right.
And things, my experience has been that the IPO market continues to go in a direction a little bit longer than people think, and perhaps it comes to a shuddering halt at some point in time, but I'm not sure when that's going to be.
Great. Thank you so much.
Thank you.